Good afternoon, everyone, and thank you for attending today's webcast introducing the Cost of Capital Navigator U.S. Industry Benchmarking Module. Before I introduce our speaker and get into the presentation, I'd like to tell you a little bit more about Duff Phelps. Duff Phelps is a global advisor that protects, restores, and maximizes value for clients in the areas of valuation, corporate finance, disputes and investigations, compliance and regulatory matters, and other governance-related issues. We are the largest independent valuation consulting firm in the world. We have more than 3,500 professionals located across 28 countries around the world. We enhance value across a range of services and to date have over 6,500 clients, including the leading companies across all industries. We serve over 45% of the Fortune 500 and over 60% of the Fortune 100. Now, just a few quick housekeeping items before we begin. This webcast is being broadcast live. We suggest you enlarge your media player to full screen when viewing the presentation. Some of you also may need to enable Adobe Flash, so please do so by right-clicking any prompt. We also encourage you to submit questions throughout the presentation. You can submit questions electronically through the webcast console Q&A widget. If we don't have a chance to answer every question, we will be sure to follow up directly after the webcast. We encourage you to also make use of the resource widget on your console for additional information on our products and services. And finally, a recording of today's webcast will also be posted to the Duff Phelps website and distributed to all attendees in due course. Now let's get started. I'd like to begin by introducing today's presenter. Jim Harrington is a director at Duff Phelps based in our Chicago office. In addition to overseeing development and sales for the Cost of Capital Navigator, Jim is a leading contributor to Duff Phelps' efforts in the development of studies, surveys, online content and tools, firm-wide valuation models, data distribution platforms, and published thought leadership. Jim is also co-author of the Duff Phelps Valuation Handbook Series, along with Roger Grabowski and Colin Nuns. And with that, I'd like to hand the stage over to Jim. Please go ahead, Jim.
Thank you, Rishi. And thank you to our co-sponsors today, ValueSource and NACFA. I really appreciate ValueSource's and NACFA's expertise and efforts in making these webinars successful and meaningful for attendees. You can subscribe to the Duff Phelps Cost of Capital Navigator, including the focus of today's webinar, the new U.S. Industry Benchmarking Module, through any of the sources shown here, ValueSource, NACFA, or Duff Phelps. To get started, I'm going to give you a quick overview of the Duff Phelps Valuation Handbook Series. If you'd like to learn more, you can also go to dpcostofcapital.com and you can learn more there. Duff Phelps has produced the Valuation Handbook Series since 2014. The two blue books on the right are the International Cost of Capital books. The dark blue one provides international country risk premia and other cost of capital statistics for 56 different investor countries valuing investments in any of over 180 investee countries. The light blue book provides international industry data for the world, the European Union, the Eurozone, and the UK, in 3 different currencies, the euro, the British pound, and the US dollar. Now these books aren't the subject of today's webinar, but I did want to mention them. The 2 gray books on the left are the U.S. Cost of Capital books. All 4 books are scheduled to be transitioned over to the Cost of Capital Navigator platform. The book that was transitioned over first is the book that a lot of you are probably most familiar with. That's the dark gray one over there on the far left, the Valuation Handbook U.S. Guide to Cost of Capital. That's the book that has the crisp decile size study and risk premium report study in it, and where you get the size premia, risk-free rates, equity risk premia, industry risk premia, et cetera, that are widely used as inputs in U.S.-based valuations. That one, the U.S. Guide to Cost of Capital, was transitioned over in 2018, early 2018. The second book to be transitioned over to the Cost of Capital Navigator is the light gray book right beside it, the Valuation Handbook U.S. Industry Cost of Capital. The U.S. Industry book was just transitioned over to the online Cost of Capital Navigator last month and is now called the U.S. Industry Benchmarking Module. The new U.S. Industry Benchmarking Module is the focus of today's webinar, sort of the star of the show, and it's what I'm going to be showing you today. Finally, later in 2019 and 20, all of the information and data in the two international books will be transitioned over to the online Cost of Capital Navigator platform. So starting next year, all of the great information and data that we all use, or most of us use, I'm hoping everybody uses, from the 4 valuation handbooks will be accessible to you anywhere, anytime, all in one place, the Duff Phelps Online Cost of Capital Navigator platform at dpcostofcapital.com. Today's webinar is only an hour long, and the agenda is very straightforward. First, we're going to talk about if industry data is even important when you're estimating cost of capital. As you can see from the bullet point, what the bullet point says is industry data is important. I do think it's important. Oops. Second, we'll use the Cost of Capital Navigator to estimate cost of capital for a smaller company. This isn't going to be a full-blown case study. It's going to be like a mini case study because the real focus today is on introducing the new U.S. Industry Benchmarking Module, which I think everybody who subscribes to the Cost of Capital Navigator needs and will find very useful. Then I'll summarize everything we did in the mini case study and provide some final thoughts. And finally, I'll answer some of the questions that get submitted during the presentation. And don't worry, as Rishi said, if we don't get to your question, because we've got a lot of people in the webinar, thank you everybody for attending. Thank you very much. I know you're all busy, so taking time out of your day to listen to me talk for an hour is something I'm very grateful for. So, but any questions that come in, we're going to record, and we're going to write up, and we're going to send out to everybody that's attending today. You know, so if we don't get to your question, we will get to it eventually, just maybe not during the webinar. So let's get started. Oh wait, I forgot to mention, as a special thank you for attending today, there's a special offer I'm going to have for everybody at the end of the presentation that'll save you some money on the new U.S. industry module. Okay, now let's get started. How can you use the new U.S. industry benchmarking module? Well, I think a broader question is why it's important to consider industry data in just about any valuation analysis, regardless of whether you develop it yourself from a handpicked peer group or get it from the new U.S. industry module or from some other source. I came up with 2 general reasons why using industry data is important. I'm sure there may be more that I could come up with, or you could come up with in addition to these, but for our purposes today, this is what I came up with. The first reason I came up with is information and inputs. Like I said, there's other sources of industry level data, but I'm just going to tell you what's available in the one that I'm most familiar with, and that's the new U.S. industry benchmarking module that we're talking about today, that we're going to use in our case study. I think it'd probably just be easiest to show you a sample industry tear sheet from the book, because it was produced as a book, and now it's in the Cost of Capital Navigator. So let's just get out of our slide deck, and I'm just going to show you a sample. This is SIC 56 as of June 30th, 2019. It tells you the number of companies, 23. This is apparel and accessory stores. Just a random industry tear sheet. You can see it lists the 3 largest, 3 smallest companies. It's got some performance statistics here. return ratios, return on assets, return on equity, dividend yields, liquidity ratio, current ratio, some profitability ratio, a measure of profitability, operating margin here. Gosh, I'm getting hung up there. Some growth rates, long-term earnings per share, betas. Everyone uses betas in one way or another, whether you use a buildup with an industry risk premium, which is just a beta that's been specially adjusted, or you use the CAPM, you need a beta. And some of you, I'm sure, identify your own peer group, comparable group to your subject company and calculate your own. That's always great to do. It's also great to just cite an independent source that calculates an industry beta. And you can see we calculate quite a number of them. We calculate raw OLS betas, Bloom adjusted betas, peer group betas, Vasicek adjusted betas, some betas, downside betas. Those are all levered. We also calculate them unlevered. We calculate equity valuation multiples, price to sales, price to earnings, market to book, enterprise valuation multiples, EV to enterprise valuation to sales, EV to EBITDA, etc. Some FAMA French numbers, leverage ratios, in other words, capital structure, debt to market value of equity, and debt to total capital. Debt to total capital is one of the ones we're going to use in our debt to total capital and betas. We're going to be using those as inputs in the case study today. Cost of debt, we're going to use that also. Cost of equity capital. Okay, cost of equity capital calculated using the CRISP deciles size study, the risk premium report, discounted cash flow, FAMA French, and then also weighted average cost of capital by industry. Okay, and this is all by median. Okay, median just means the typical observation in a group, the middle observation. SIC composite, that's just sort of the average. The large composite, that's the average of the largest companies. Small composite, that's the average of the smallest companies. And then even a high financial risk study, which enables you to, is a calculation of the companies in this SIC that were distressed or maybe in some trouble. With that, I'll get back to our presentation. Let me just hit. Okay, so the first thing we can get is information and inputs. And I just listed to you quite a few of the information and inputs. The second reason I came up with is benchmarking. Okay, why is benchmarking important? Benchmarking is important because it can support and even strengthen your own analysis. Here's a simple example. Suppose you've done all of your analysis and you've concluded that the WACC, the weighted average cost of capital of company ABC, is 9%. Now, you've also done a careful analysis of a hand-picked group of other companies that are similar to company ABC and operate in the same industry, and find that the average and median WACC of those companies, those 10 companies, those comps, are 9.5% and 8.5%, which is right in line with the WACC estimate for company ABC that you calculated, your subject company. So you're probably going to feel pretty good about company ABC's 9% estimate. Let's call this scenario one. In scenario one, the industry calculation supports, and I'd argue strengthens, your 9% conclusion for company ABC's WACC. By strengthens, I mean it makes it more compelling, more defensible. You know, if somebody challenges you, I think that you've got a little more ammo to say, look, I calculated similar companies, and they're all sort of clustered right there around where I come up with the subject company. Now let's do hypothetical scenario two, where you've done a careful analysis of a handbook group of other companies that are similar to company ABC and operate in the same industry, and find that the average and median WACC are 15% and 16%, which is significantly different than your estimate of company ABC's WACC, which is 9%. you're probably not going to feel as good about the credibility of company ABC's 9% estimate in this scenario. The industry stats just don't seem to support the 9% conclusion and arguably make it less credible and probably less defensible in this case. Does this mean that your 9% WACC estimate is, quote, wrong? Not necessarily. It could just be a red flag that you've made an error someplace, either in the company ABC's calculations or in the peer group calculations, or maybe both, or neither. I mean, at the very least, though, this kind of result is going to want to make you investigate why company ABC has a WACC of 9, which is so different than the other companies seem to have in the industry. And there may be a reasonable explanation. However, if the results of that investigation don't yield a reasonable explanation, then the 9% WACC for company ABC that you calculated is just not as supportable or defensible as was the case in scenario 1. So if somebody challenges you, you're either going to have to explain why it's so different, or I don't know where I would go with that one if I didn't have a good explanation, quite honestly. But you can see that it isn't as compelling as scenario 1. So let's get to the meat of today's webinar, just a mini case study. This is going to be a live case study using the cost of capital navigator to estimate cost of capital for our subject company, David and Brian's Gadgets. Okay, I named that after David Fine at ValueSource and Brian at NACFA, David and Brian's Gadgets. And we're going to incorporate some inputs and also some benchmarks from the U.S. industry, from the new U.S. industry benchmarking module into our analysis. So, wait, I've got to go over some of the assumptions first. Here's the assumptions for our subject company, David and Brian's Gadget, which operates in SIC 36, electronic and other electrical equipment and components except computer equipment. The valuation date is December 31st, 2017. Over there on the right-hand side, you've got some size characteristics, subject company size characteristics, 8 different size measures, because we're going to be using not only the CRISP deciles today, but we're also going to be using the risk premium report. Value of equity, 12 million, book value of equity, 10 million, 5-year average net income, 1 million, market value of invested capital, 18 million, total assets, 20 million, 5-year average EBITDA, 2 million, sales, 15 million, and number of employees. That's the only one that is an actual number. The other ones are in millions. David and Brian's Gadgets does not have 5 million employees. It's got 5 employees. Okay, now we're going to go live to the cost of capital navigator. And I'm just going to use my employee login. Otherwise, you would log in, as you all know. Whoops, I think I typed something wrong. And you would go to dpcostofcapital.com and log in. Why is this doing that? I'm just trying to use my... Okay, I think we have the answer to why that was doing that, because it was operator error. I was clicking the wrong URL. Okay, here we are. This is the Navigator homepage. It looks pretty familiar, right? You can start a new cost of capital estimate over here, the big blue button on the right. And over here on the left, you can look at all of your previous estimates. This is just a preview. If we clicked Review All Estimates, it would take us to a page that showed us an unlimited, basically as many estimates as you've ever done are just stored there and you can look at. And no one else can look at those, by the way. Not even nobody at Duff and Phelps, nobody at anywhere can look at that except for you under your credentials. Okay, so but there is something a little bit different here. If you'll notice down here in the lower right, there's another big blue button that says Start Your U.S. Industry Benchmarking Analysis. So I'm just going to click on this and let's just take a look. Very familiar, very similar to the module 1, which we call the U.S. cost of capital, the one that all of you've got right now, but very similar setup. I'm going to choose, let's just keep it there, September 17th, 2019, and let's pick out an industry. Let's pick out, let's see, it's the same SIC that I used before when I showed you what was on the page. And you can type in the SIC 56, or you can type in a keyword. I could have clicked in apparel and accessory or whatever, and it would have searched for it. Over here, you can view, before you even look at the tear sheet, at the industry sheet, you can say, well, what companies are in there? Okay, and you can see I can look at the SIC composite, which is all of the companies. I can sort them by sales from lowest to highest, sort them by assets to get an idea of how big they are. I can look at the large composite, the companies in this SIC that were used that are the biggest companies, and I can sort here also. I can look at the small composite. Okay, in this particular one, we've got some pretty big numbers. The small composite in SIC 56, it looks like Buckle is $885 million, which is a little bit bigger than our subject company, but this is a different industry. And even the high financial risk, it can give you a list of that. I think that's a great thing, because even before you go, you can search around in here, in this field, and look at the companies and say, are these companies really the ones that sort of are like my subject company? After doing that, you can click continue, and it just takes you to a page. And remember that SIC, that tear sheet from the actual book that we were looking at? Here it is in the Navigator. It just pulls the whole thing up. Okay, pulls the whole thing up. Again, up here, while you're looking at the thing, you can look at the company list again. You can look at the company list and do all the things that I just showed you. You can download it. Right here, up in the upper right, is a PDF button. You can download this and put it in your work documents. Here's an Excel spreadsheet that downloads exactly what you're seeing here into an Excel spreadsheet. Okay. If you say, for instance, you use one of these numbers and you say, you know what, I'd like to know how one of these numbers is calculated. Like, for instance, what is this return on equity? How is that calculated? Or this Vassicek adjusted beta, how is that calculated? Well, one of the great things about the Navigator, and one of the things that I'm very proud of, is our resources section. So let's go to our resources section. Here's the resources section for Module 1, the U.S. cost of capital, the one that almost everybody in the audience has probably got already. It has the CRISP deciles and the risk premium report. If I click over here, the U.S. industry benchmarking module, there's a resource section for that. And I can click on methodology, and you can read all of the methodology, how, the big picture. And then if you really want to, and you can download it, you can just right-click, save as, put that in your work documents. You can take a screenshot, however you want to do it. But like I said, I would probably just right-click it and put it on my screen in my work documents. If you really, and then that's the methodology is just sort of the high level how we do things. If you want to see the nitty-gritty, the calculation of the industry statistics, you can click on there, and every single calculation for all 300 and some data points that we saw on that page are outlined and documented so that you can put that in your work documents. It's really great. And you can also, some of it's pretty useful because many of you use these types of equations. You can refer to this as just sort of a resource book too if you want to do your own calculations. Let's go back to the home screen now. Okay. Now you can access the new U.S. industry benchmarking module by clicking this button here. Okay, if you're subscribed, you can click and you can just, you can go in there and you could pull an industry or, whatever you want to do. Or a lot of you, I mean, we were talking in my examples of why benchmarking is a good thing. We're talking about calculating WACC and then comparing it to, say, industry averages and everything. So a lot of times what people do is, what you'll want to do, I imagine many of you will want to do, is you're going to want to look at this stuff and use either inputs or benchmarks or both as you're doing your cost of capital estimate. So let's do that. So long story short, you can go in and get individual industry tear sheets by clicking this button and just, if you don't want to get into an estimate and everything, or you can click start a U.S. cost of capital estimate, and we've integrated the U.S. industry benchmarking module right into that also. Let me show you how that works. I'm going to start here, and I said the name of our subject company was David and Brian's Gadgets. Okay, probably everybody in here has done this, right? Today, what did I say? I said my valuation date that we're going to use for the case study. They always want me to use old data, so I have to be careful. I'm going to use December 31st, 2017. How far back does the Navigator go? It goes all the way back to 1999. I just want to, most of you know that. For anybody that's new, I just want to tell you, it goes from 1999 to present. Okay, and here, David and Brian's Gadgets, the SIC they were in was 36, which is electronic and other electrical equipment. Okay, like I say, you can always click, if I want to make a determination, and see whether the companies are similar. I just sorted it so I could see the really tiny companies up here. I look at this and I say, yep, this looks like the one I want to look at. I can also go in there and just look at the small composite, which is probably more appropriate in the one that we're going to use in the example today, because David and Brian's Gadgets is a smaller company. But anyway, so I'm going to save this and I'm going to continue. This looks very familiar to most of you. For those of you that are new and haven't subscribed to the module 1, which is the U.S. cost of capital module, there's two studies in here: the crisp decile size study and the risk premium report study. And I'm not going to. Time is short, and I'm not going to do a big thing on here. Like I say, the star of the show is the industry module, but you can do CAP-M under CRISP. You could do a build-up. You can go to the risk premium report. You can do a CAP-M plus size premium, a build-up 2 that incorporates an industry risk premium, a build-up 3, which is the risk, the accounting measures of risk, operating margin and coefficient of variation of operating margin, et cetera, to estimate cost of equity capital. But, let's just go back, and for our mini case study today, let's just real quick do a crisp decile size study. That's the old Ibbotson stuff. Let's just do a build-up. A lot of you use build-up. Okay, so the first thing we need is we need a risk-free rate. You can choose something off the shelf. You can choose the spot rate, which we pull in, the Navigator pulls in on a daily basis from the Federal Reserve, or we can use the 3.5% Duff Phelps normalized 20-year Treasury rate as of our valuation date, which is in the drop-down, or we could type in some, if you get it from a different source, you can say, well, I want to use 3.4% or something. But today's, you can type in anything you want, and that's true throughout the Navigator. All of these fields have off-the-shelf values, and then they have, you can type in, overtype. But today we're just going to pick the Duff Phelps 3.5%. Okay. Now I need a equity risk premium. And here, again, off the shelf, we've got the historical long-term. That's the old Ibbotson ERP, the supply side. The Duff and Phelps recommended which is the one that you have to use if you use the Duff and Phelps normalized rate, so we're just going to use that. Our industry risk premium. Now, what did I say earlier? I said the industry risk premium was just a beta that's been adjusted so that it could be used within a buildup. Okay, so I mean, here we supply you with some off-the-shelf values, but I want to go to the new U.S. industry benchmarking module and pick my own beta. I want to see if I can find something more appropriate maybe than what we have provided off the shelf. So look up here in the upper middle of your screen. It says Step 4, U.S. industry benchmarking. I click that, and the SIC that I picked as of my valuation date pops up. It's right there for me to use. I'm going to go down here, right here. I've got some betas, okay, right here in the middle of the screen, upper left. And I'm going to use, I've looked at this, and I know my company is really small. So I'm going to use the small composite. I'm going to pick one of the small composite betas. Okay, I don't want the SIC composite. I don't want the large composite. I don't think David and Brian's gadgets is high financial risk. It's a healthy company. So but it is small. So I'm going to use the small composite. And in this case, I think I'm just going to pick the small composite sum beta, okay, of 1.32. And I'm going to go back here. You know what? First, I'm going to put this in my work documents. I told you before we could save this, but watch this. I want to save this. I'm using something from this, so I want to use it in my work document. So I'm just going to click that button and look, download, and I'm going to save this. I'm going to give it a descriptive name, SIC 36, David and Brian's gadgets. What did I say? It's December 31st, 2017. Okay, and I'm just going to put that in I've got work papers for David and Brian set up, so I'm going to put that in there. So I've got a record. I used a number from that. I want to have that in my work documents because I'm going to put that in my engagement documents. Okay, so let's go back here. I said I was going to use 132, small composite sum beta. I'm just going to go back to my cost of capital estimates, risk premium report. Which one was I doing? I was doing this. I was doing crisp deciles buildup. So we still owe it basically a beta. So I'm going to type in my beta that I got from the new U.S. industry benchmarking module, and it automatically, based upon my equity risk premium, it automatically calculates the appropriate industry risk premium of 1.6%, okay? Automatically does that for me, okay? And notice that everything's labeled. You know, as I've chosen these, the cost of capital Navigator is labeled. I use the Duff and Phelps normalized rate. I use the Duff and Phelps recommended ERP. This is a custom industry risk premium that I typed in, and then I want a size premium. And I said market value of equity and our assumptions was 12 million, and I'm just going to use decile 10. Okay, so we've calculated our first estimate of cost of equity capital for David and Brian's gadgets, 15.47, using the crisp decile size study build-up method. Okay, now, and we also used information from the new industry benchmarking module, which is great. Very handy. So here, let's do a risk premium report. Since we did a build-up in the crisp deciles, let's do a CAPM here. Okay, big difference between the risk premium report and the crisp deciles. Crisp deciles is size premia defined by market cap only. Risk premium report, size premia defined by market cap plus 7 additional size measures like book value of equity, 5-year average net income, etc. I'm just going to, and you notice that the Navigator remembered the risk-free rate and the equity risk premium that I used, and it's already filled those in. It's asking me, what do you want to use for beta? Well, I want to use the same beta. I'm going to use my 1.32 sum beta for the small composite from the new industry module, okay? And it fills it in all the way down. And then I'm going to get some size premium. It remembers that I typed in 12 million in the CRISP decile, so I'm just going to click Save to tell the Navigator, yes, I want to use this in my results. And then I'm going to click in my other size measures for David and Brian's gadgets. It had a book value of equity of 10 million, a 5-year average net income of 1 million, a market value of invested capital of 18 million, a total assets of 20 million, let's see, 5-year average EBITDA, 2 million, sales, net sales, revenues basically, 15 million, and number of employees, it wasn't 5 million, it was just 5 people work for that company, right? Not 5 million. That would be a really big company. Okay, so now we've calculated cost of equity capital using the risk premium report and using the CAPM and size premium. And you know, since we did a build-up in CRISP, and a lot of you use build-up, let's do a build-up in risk premium report too. Also, you can see it remembers everything that we entered. We're going to do it instead of a CAPM. We're going to do a build-up now using the risk premium, and it already calculated automatically our equity risk premium adjustment for us, so we don't need to worry about that. It's a special adjustment that you can read about in the resources section. But here, I'm going to have to tell the Navigator that I want to use that, and it remembers what I typed in before, 12 million. It remembers what I typed in for book value of equity, and I have to go through and type these to tell the Navigator, yes, I want to use these in my results. So I'm just going to go through real quick and do that. Okay, there was an unexpected error processing your request. I don't know what that means. Anyway, okay. So we've now calculated cost. Oh, it's because I didn't hit it right. Here we go. There we go. Now I got it. Okay. So now we've calculated cost of equity capital using the CRISP decile size study. We did a build-up in that, and then a CAPM and a build-up in the risk premium report. So it's a total of, what, 8 plus 8 plus 1, 17 different ways we did that. Let's take, since we're not going to do any unlevering and relevering and anything else like that today, this is a real simple thing. We want to use the new industry module. So I'm going to go to my results. Let's take a look at my results. We didn't calculate unlevered, relevered, or high financial risk, so it's limited results, but average cost of equity capital across all of those 17 estimates that we just made was 15.02% for our subject company, and the median or typical estimate was 14.98%. Okay, and then of course down here is all the it records everything that you used and all your assumptions and everything. And again, your results for in Module 1, the cost of capital, U.S. cost of capital, you can also download that in PDF up here on the upper right or in Excel, okay, just like the U.S. industry. But I want to continue going. I need a WACC. I said we were going to calculate WACC, weighted average cost of capital, for David and Brian's gadgets. So let's calculate WACC. Cost of equity capital, well, we just calculated that 17 different ways. And we can type in, we could go through and we could pick out one that we really liked or thought was most appropriate, or we can just do the off the shelf. I give you the average and the median cost of equity capital of the 17 estimates that we just did. Let's just use the median, the typical. I'm going to use the typical cost of equity capital. Okay, weight of equity. Well, I want to use a target capital structure. Okay, so I want to know what the industry capital structure is. Let's go back to the U.S. industry benchmarking module. We told it our SIC was 36. One of the statistics that's calculated is what we call leverage ratios, right there in the middle of the screen. I highlighted in blue there. Also, it's just capital structure, debt to market value of equity, debt to total capital. I want to use, again, I'm a small company. I want to use the small composite, and I want to use the 5-year average. I like averages, actually, you know. Let's use a 5-year average. That takes a little bit of the noise out of it. It's 13.4% is debt to total capital, okay? So let's remember that, 13.4%. Let's go back to our results. Oops. We used the median. Weight of capital was, what did I say, 13.4%. So the weight of debt was 13.4%. So our weight of equity was 100% minus 13.4%, or 86.6%. Cost of debt, I need that one too. I'm going to save that. Okay. And I'm going to go to the U.S. industry benchmarking module because now I need a cost of debt. Again, for SIC 36, as of my valuation date, the small composite cost of debt looks like it was about 4.4%. Okay, that sounds good. Let's go back here. Okay, cost of debt, 4.4%. And tax rate, I'm just going to use, after the Tax Act, it's, 21% is the top marginal, or the corporate tax rate. So I'm just going to type that in. So now I've calculated a weighted average cost of capital of 13.44% for David and Brian's gadgets. Okay, and I used, what did I use? I got my beta and my industry risk premium basically from the new industry module. I got my capital structure. I got my cost of debt. Okay, I used a decent amount of inputs here to help me come up with these. Now, in addition, many of you will probably calculate, you'll identify a peer group and identify some, and make these calculations, that way independently, but it is always good. This is a great resource, you either save you're doing that yourself or add to what you've done yourself to make it more compelling, more defensible. Okay. Now, I think what I'm going to do is I'm going to go back to, let's go back to the slideshow. And let's talk about what we just did. And like I say, it's a mini demo. As a matter of fact, on November 8th, NACFA they're doing an expanded case study webinar, and I'll give you the information on the end. You might want to sign up because that one will be more. That will be more nitty gritty. It'll be a more developed. We'll do more things in that one than we did here. But anyway, so the summary for today. What did we do? I said there was 2 things you can get from the new industry benchmarking, U.S. industry benchmarking module, industry inputs and benchmarking. Let's look at industry inputs we used first. Well, our industry was 36, SIC 36. We decided to use the small composite, sum beta 1.32, and we used that not only in our CAPM, we used the 1.32 in our CAPM, but when we did a build-up that required an IRP, the Navigator automatically calculated, based on this beta of 1.32 in the ERP we chose, and it automatically calculated for us the industry risk premium needed. So that's input 1 that we used. We also wanted to calculate a WACC. So we needed a capital structure. So again, we used the small composite debt to total capital. 5-year average, 13.4% debt to total capital, implying that 86.6% of our capital structure was equity. And then we also used 4.4% cost of debt, which is great. I mean, these are very useful things to help us do our analysis, our custom analysis of our subject company. Now, the second thing is industry benchmarks. We haven't really looked at those yet. But remember I said, let's take a look at how we can benchmark. Remember my example, the 9% and the, before, and if everything sort of comes up clustered, it actually makes it more compelling, more defensible. Same thing here. This is basically that concept here. Our average cost of equity capital and median cost of equity capital for David and Brian's gadgets was 15.02% and 14.98% respectively, or about 15%, about 15%. Down here on the bottom half of this screen, it's just a snippet from that U.S. industry benchmarking tear sheet for SIC 36, and I've got circled the results of the models that we used. We used a CRISP deciles buildup and a risk premium report CAPM and buildup, and those were 13.2%, 14.6%, and 14.9%. Seems like we're right in the ballpark. That makes me feel pretty good about my estimate. Now, as far as WACC, we went ahead and used some inputs, cost of debt, capital structure, et cetera. And we calculated a WACC for David and Brian's gadgets, and that came up to be 13.4% for the Navigator. Again, at the bottom of this screen is a weighted average cost of capital, just a section of that tear sheet, that industry tear sheet from the new U.S. industry benchmarking module for SIC 36 that we used. And the models that we used were built up under CRISP and risk premium built up in CAPM, and those were 12.5, 13.8, and 14.1 for the small composite. Again, for the small composite. I mean, that makes me feel, I feel like a superstar, actually. That looks pretty good. I mean, that's very defensible, very supportable. It indicates that it supports what we did here in our own analysis of David and Brian's gadgets. Okay. Now, I mentioned that I was going to have a special offer. It's 10% off. Okay. I hate to sound like the ShamWow guy here, but I mean, I do want everybody. I personally, I really do believe. Okay, not just because I would love it if you buy the thing, the module, but I really do think that everybody needs to incorporate some kind of benchmarking statistics, and also all of us need inputs from time to time. So this is a great resource for this. So if you want to get it, you can go to DP Cost of Capital and use that USI 10 code, and it'll give you 10% off. Okay. Now, questions and answers. I've got two guys in my office right now. We've got Andrew Vay, who's an analyst here at Duff Phelps and works on the cost of capital Navigator, et cetera. And we've got Will Edwards. Will is an intern. He's at DePaul University here in Chicago. Okay, so they've been monitoring, and we've got a fairly large number of people that showed up today to listen in. Much appreciated. And did we get a lot of questions?
Yeah, we did. So
can you give me a couple of the
Yeah. So as Jim said earlier, we got a lot of questions. If we don't get to your question today, we will be answering all questions and sending them out to all attendees. But the first question we got, I think you can answer, Jim, is someone asked, your cost of equity capital was a little higher than the benchmarks. Why would that be?
Okay, and that's a good question. As a matter of fact, I was here. Can we just go back? Let's go back to the cost of capital Navigator real quick here. Go back into our industry. Oh, I think I timed out. Here, wait a minute. Let's go back. I timed out. Let's go back in, and real quick, I think I know what's going on with that. Even though our benchmarking looked really, really good, but let's just go here and sorry, and we were what, 36? Okay, let's take a look here. What was the sales? The sales of David and Brian's gadgets was $15 million a year, and the total assets was $20 million. Let's look. Remember, you can look at the industry list here, and I'm just going to sort those two things. Let's see. Sales. The smallest companies down here look like they might be just a little bit bigger than ours. Okay, we get some 30s, some 20s, stuff like this. So all things held the same. I mean, our sales were only 15, okay? So all things held the same. I think our cost of equity capital might be a little bit higher than even the smallest companies in this industry, okay? And that's another great reason that we put the companies and some way of gauging how big they are in the Navigator for you. What other questions you got?
Okay. Someone else asked, I bought this 2019 U.S. industry physical book earlier this year. Do I have access to this new module in the Navigator? The answer to that is yes. You should have received an email last week with instructions on how to create an account for the Navigator to this new module about a week ago. You will retain access in the new module until March 31st, 2020. If you have any trouble getting into your account or you didn't receive the email, please reach out to our support at costofcapital.support@duffandphelps.com if you have any questions on gaining access.
Okay.
And then another question we got is, can I sign up for a free trial to the U.S. industry module? The answer to that is yes. Just like Module 1, you can sign up to a 14-day free trial to test this new module. Just visit dpcostofcapital.com and look for the start free 14-day trial on the top right. And then after that, just to go over some pricing, the basic subscription to this new module is the 2 most recent years of data, and that is $675 a year. The pro subscription, which goes all the way back to 2014 for data, is $995 a year.
Okay, I mean, and for people that Andrew talked about, people that had already bought the U.S. industry book in physical form, we published that in physical form and sent it out to people since 2014. Everybody that has already, bought the book has automatic access to the module, and we're still going to send them out their books through the September and December updates. Also, this is going to make the people that bought the book feel bad, but not too bad, because the book is $675 just for 1 year of data, and the module for the basic subscription is $675 for 2 years of data. So it's sort of a better deal, actually. I mean, it's great info, and like I say, it goes all the way back to March 2014. And here, we'll answer a question. Will's our intern. Will, how often is this data updated?
It's updated quarterly.
Updated quarterly. Okay, thank you, Will. What other questions you got?
Someone else asked, can I select more than one industry? Yes, in step 1.
Yep.
I think Jim went over.
Well, I'm just going to show them.
Okay.
Sometimes it's easier just to show people, right? I'm back in I went back into the Navigator here, and like I said, the industry module's integrated into the existing cost of capital estimate thing, but you can also just enter it down here if you just want to grab a tear sheet or something just individually. Let's pick here 3.6. This is what a lot of people do, by the way. They'll go, David and Brian's, for instance, was in 36. But I want to see if there's something more specific. Let's try SIC 367, which is even more specific. Let's try SIC 3672, which is really specific, printed circuit boards. That's how SICs work. The more digits in them, the more specific. The fewer digits, the broader. But again, you can look at all the companies that were used in these, or we can just, we can click continue, and it takes us over here to, well, there's our SIC 36 that we were looking at, and I can click in the upper right over here. I can just click this button to go over. There's 367. Let me see how many. There were 83 companies in 36. It was very broad. We get down to 367, a little bit less broad, a little narrower. There's only 50 companies. And then when we get down to 3672, which is just printed circuit boards, there was only 5 companies used. But in a lot of the calculations, there weren't even enough information to calculate. There was still good information, but we couldn't calculate, for instance, a small composite for this one because there was only 5 companies in it. It would sort of be non-meaningful. So yes, you can choose individual or multiple industries. You can scroll through them and compare. Okay, you can download PDF or in Excel each and every one of them into your work documents. Pretty useful stuff. Pretty useful stuff. What other questions do you have, Andrew?
Another question is, how many industries are included in the U.S. industry module? I think this question Will can answer.
Yeah, it depends on the valuation date, but per quarter, about 170 to 180 industries.
Okay, so this module calculates about 170 to 180 U.S. industries per quarter since March of 2014. That's pretty good. That's pretty good. Good information. What else you got?
Another one is, Jim already talked about this, but what would I use the company list for? I just want to reiterate, the company list function shows which companies are included in the calculations for the selected SIC code. This would be useful to see if your company is actually comparable to the companies included in that SIC calculation. You can go in and see if your company is actually similar to the companies in there, and it'll give you a better idea if that SIC code is right for you.
That's a good answer. I want to add to that answer, though. Each of the, I mentioned earlier that a lot of you, in addition to, using off-the-shelf industry data from either the new U.S. industry benchmarking module or some other source, a lot of you also identify your own peer groups and want to calculate yourself certain statistics for them. Maybe your own betas, maybe your own whatever, okay? So the U.S., the industry lists, that show up here are really useful. It's sort of like a starter kit for comps. Okay, it's like it gives you an idea. I mean, I know everybody listening can identify comps, but sometimes comps can be sort of a pain in the, sort of a chore too. So this gives you sort of a starter kit. And like I said, you can sort them. If you're looking for really tiny companies, you can sort them and you can say, that one matches, that one, not so much, this one, whatever. But it gives you a starter kit, ideas basically to do your own peer group custom analysis and develop your own statistics for that set. Something else that I really should mention is that every single company that is used in the U.S. industry benchmarking module is what we call a pure play company. Okay, what do I mean by that? There's companies like GE, General Electric used to be the example. I don't know how much of it is an example anymore, but of a conglomerate that just participated in, 20 different businesses and really wasn't just located in one business. A pure play company, on the other hand, is a company that derives most of its revenue just from one industry. Okay, and a lot of companies are like that. The way we define it in the U.S. industry benchmarking module is every single company that's used, every single company in any industry that's used has to derive at least 75% of its revenue from the industry that we put it into. Okay, so you can be assured that any of the sort of the off-the-shelf peer group starter kit companies that you look at, all of them are pure play, which is great. What else? What other questions you got?
So that's about it. I think it's
we're at 12:02. Yeah, we've run over. Again, all of the questions, because there was a lot. We had a lot of people in here. Andrew and Will have recorded all of them. We can download those from the platform we use for the webcast, and we're going to answer all of those and send them out to every single person that signed up for the webinar, so that if we didn't get to your question, we're going to get to it. You'll get your answer. Again, I want to thank everybody for taking time to listen in today. That code, let's go back to that. Again, you can save 10%, and that's a thank you for taking time to listen in today. USI 10, and it automatically gives you 10% off. Okay, thank you again for listening in. Thank you to ValueSource and NACFA for co-sponsoring. Thank you to Rishi for working on organizing all this, and for doing the introduction. And with that, thank you, and have a great rest of the week.